The Bank of Canada is raising the interest rate by 100 basis points, the highest hike since 1998, up to 2.5%.
We did not take this decision lightly. We are acutely aware that higher interest rates will affect Canadians who are already feeling the pain of high inflation. It can seem counterintuitive to add to the interest cost Canadians face in order to combat the cost of inflation. But by increasing the cost of borrowing, we will moderate spending and return inflation to its target.
So, cutting inflation is the goal. Will these latest moves get the inflation target closer in sight? Jimmy Jean is Vice President and Chief Economist with Desjardins and is in Montreal. Armine Yalnizyan is an economist and Atkinson Fellow on the Future of Workers. She's in Ottawa. Hello to both of you.
Good afternoon.
So, biggest single hike since 1998. What does that kind of an increase tell us about how bad the circumstance is? Jimmy, I'll go to you first.
Well, we've seen this string of upward surprises in inflation in Canada, also in the U.S. We saw that this morning with fresh estimates still beating consensus estimates. So we're still very much in a crisis of inflation control. What we've seen lately in terms of the job market, a very tight market, accelerating wages in Canada. Wages are now growing faster than they are in the U.S. And in places like here in Quebec, we're talking 7.5% wage growth. So the Bank of Canada talked about the risk of a wage spiral today, and that's one of the motivations for this kind of outsized move. So there's a number of factors, but it's really about winning the war on inflation. And I think the Bank of Canada today shows that it's really to do whatever it takes to really bring down inflation.
And I'm going to go to Armine in a second, but Jimmy, we can hear you, but I think your microphone might have fallen off. If you just want to check that while I put kind of the same question to Armine, which is, I mean, is this a signal that the Bank of Canada thinks we're headed toward a recession? What do you think?
Oh, I don't think it is that kind of a signal. I think it's a signal that they want to show that their ability to handle inflation has not been impeded overly by things that effectively raising the interest rate can't control. Things like higher food prices and commodity prices, things like higher oil and gas prices. Nothing about raising the interest rate will affect those prices, but it'll do two things. It will affect housing prices, and it will cool demand. And I guess that's the overriding thing, is to get people to spend less, and because we are in a moment of effectively full employment. We've got almost as many people looking for work as we have job vacancies. So quite apart from unemployment rates at half-century lows, we've got a lot of people working. So I guess they feel like this is a time they can risk triggering a bit of a recession without too much pain, or with less pain than they have in the past. It is a gamble. They're taking a walk along a tightrope, because you cool the economy too fast and you do trigger a recession. But I don't think that is their intent. I know that isn't their intent. I hope that isn't their intent anyway. But they are there to cool the economy and to cool people's expectations of what are going to happen next. As Jimmy pointed out, today's inflation rates in the United States beat expectations, and we think that that might happen in Canada next Wednesday when our inflation rates are announced. And
Armine, I mean, I guess the answer to this is it depends on the household, and it varies from household to household. But I think a lot of people are wondering today, like how serious is this pain going to be for people?
I actually asked myself the same question. Does this move actually hurt more people or help more people? One of the ways of answering that question is, what share of households even hold mortgages? We're not even talking about the over-leveraged. So let me just do a little Russian doll thing for you. Over 30% of Canadian households are renters. Another 40% own their homes, but they have no mortgage. So of the 30-odd% that have mortgages, about 1 in 5 are over-leveraged. and they will be heading into trouble. The good news there is that most of those over-leveraged households are high-income households, so they can weather the storm much better than the poorest Canadians. But again, the thing that is really that poor Canadians are staring down right now with the inflation game is the cost of food. And there's nothing about this move that is going to lower the cost of rental housing, which is insufficient for what is happening in the big cities right now. There's just nothing that is expanding supply fast enough in the rental rental housing market, and affordability is the name of the game right now because people's wages are not keeping up with inflation. They're losing ground, so they're spending an awful lot on absolutely the basics, housing, shelter, and gas, of which this will help only one thing: new people buying into the market, not renters.
Jimmy, thanks for the fast work on the microphone. I see you're back up and with us. The Bank of Canada governor, of course, saying the goal is to get inflation back to that 2% target. Do you think this will help do that?
It will help do it 100%, but not tomorrow morning. It will take anywhere between 1-2 years before we see the full effect of those rate hikes slow down the demand and inflation. We have to remember policy operates with very long and very variable lags. So that means for the time being, a lot of that is also about a moral suasion exercise to convince people that the Bank of Canada is on top of this, is acting forcefully, is ready to surprise even financial markets. Nobody was really expecting that outcome today. And also in a bid to protect and defend their credibility and assert their authority on inflation fighting. And this, we know in recent conversations, this credibility has come under intense pressure. So I think it's for all those reasons that we saw this move today. I do expect to see more hikes down the road. I think there's at least 75 basis point worth of hikes in the next upcoming 2 meetings. That will lead us above the neutral rate. But that also means that we're going to be 150 basis points above the peak we saw in the cycle of 2020 that ended in 2018. And that was a level that where the Canadian economy couldn't withstand further rate hikes. The Bank of Canada did have the intention to rise further, but it couldn't because of how fast the housing market was slowing. Right now, we're expecting even a bigger slowdown in the housing market. So I think at one point, the Bank of Canada will be ready to call a pause on this and take stock. The only question is whether it will have done too much by then, whether it will be too late, and that would imply that the economy would head into recession in 2023.
Armin, I saw you nodding your head a lot throughout that off camera. Do you want to weigh in?
First of all, I completely agree with Jimmy that this is partly a credibility exercise because everybody understands, including the governor of the Bank of Canada, that they are not going to affect the price of food or oil. But they need to be seen to do something. They have 2 mandates: stabilize prices and stabilize expectations of prices. And that is partly the game that they are playing right now for all of our sakes, to actually calm people down and say this isn't going to continue galloping ahead with nobody doing anything. The other part I will say, though, even though I said rising interest rates are mostly going to affect mortgage holders, and particularly the over-leveraged mortgage holders who happen to be pretty well heeled by and large. The part of this exercise of raising rates rapidly that you mentioned earlier was that there's going to be a lot of lower paid people working in marginal businesses that are going to be hard hit by higher costs of borrowing. They might be on the edge already in just staying afloat after this extraordinary period of pandemic economics of higher costs and lower revenues. So people who absolutely need to keep their job might be having a tough time keeping their job. That is the highest stakes game in this whole story, that people are losing their job. The gamble is that with record low unemployment rates and roughly just over 1 unemployed person per 1 job vacancy, maybe it won't be so bad, but it is truly a gambler's bargain.
We're past time, but I just want to go quickly on one last to both of you, if you don't mind. truth is, a lot of this is because of outside factors, right? The war in Ukraine, the supply chain issues and things like that. Is the fact that there's only so much that we can do in Canada about this anyway? Armin, first to you and then to Jimmy.
In fact, we've done a lot. Today, there was a census release of reports showing that it wasn't the central bank that saved the day in 2020. It was the federal government's extraordinary generosity in CERB payments and emergency recovery payments, in child benefits, and in seniors benefits. When we want to do policy well, we can make a difference. So there is still stuff that governments can do. We are not beholden only to the central bank to do something. In fact, their playbook is pretty thin. And really their playbook is what we're seeing. They want to cool demand. That is kind of their playbook. They cool demand by raising prices on everything. Okay, so how do we lower prices? We've got other playbooks from history that we can borrow from. There's lots more we can be doing, but there's going to be a lot of pain for a lot of people. As Jimmy said, for the next year or two, we ain't seen nothing yet when it comes to food inflation. That's going to start biting in the fall.
Jimmy, last thought to you.
Well, yeah, I fully agree. There's a lot outside the Bank of Canada's control, but I think a lot of this ultimately boils down to COVID. And as much as we'd like to hope that COVID is really behind, really that inflation is the after effects that we're still feeling from COVID, the supply chain distortions, the food price increases, the oil price increases, the lack of capacity, lack of supply. There was the war in Ukraine that came on top of that, but we already had some pressures even before that. So a lot of that has to do with the supply disruption. And I think the Bank of Canada included, everybody discovers how inelastic the supply curve is. In other words, how slow supply is to adjust compared to how fast demand can be to adjust. So we're still feeling that. So we're going to need the help of those factors ebbing for inflation to really come back to 2%. Otherwise, the Bank of Canada is going to have to engineer a very heavy recession.
All right. Jimmy, Armin, thank you for that. It's a lot to take in, but it is what it is, right? So thanks for helping us understand and look toward the future. Appreciate your time.
Thanks for having us.
Pleasure.
Hi, I'm Vashi Capellos, host of Power in Politics. See more of our show by subscribing to the CBC News channel or click the link for another video.